Hello, hello, hello. Anybody there?
Yes, good afternoon.
Good afternoon. Just giving the others an opportunity to get in and turn on their computers, and then we will begin. So, Ronaldo, where is everyone?
Well, Mr. Wilkinson, I think they take another midterm break.
It would appear that way. I'm going to give them a few more minutes, and then they're going to have to play catch up.
All right, I guess what, 6:20?
Yeah, about 6:20.
I mean, yes, okay.
All right, I guess the others will catch us up when they finally get in. We need to get started. So let me just see Ronaldo is here. Ronaldo, are you still there?
Yes, sir.
Dequiza, are you there? Dequiza? Okay, Maria, are you there?
Yes, Maria's here.
Okay, wonderful. I got your note, Maria. I'm going to respond um, with what I hope is a little good news. But I'll send that to you under a separate email.
Okay, thank you.
If you don't get it in 24 hours, send me a note and say, hello, what about the thing?
Will do.
Please. Okay, who's next? Makita.
Yes, I'm here.
Okay, excellent. And I see Charles. Are you there, Charles?
Sorry, good afternoon, Mr. Wilkinson. Hello, everyone. I'm here.
Yes, how are you today?
I am good.
Wonderful. Suddenly we are in the last class somehow. I don't know where the time keeps going, but it keeps flying. And so we just have to adjust. Okay, so let me just pull up my share screen. So we can scroll along. I know you have your notes, just in case you want to look on as well. Can you guys see this balance sheet?
Yes.
Yes.
Now, I'll tell you, we are going to look at a couple of basic financial statements today so that you as governance people will have at least an idea, if you don't already, about the basic financial statements for any particular company, so that if you hear or see some of these things along the way, you wouldn't be totally in the dark. Some of it will actually make sense to you. Um, and so as a result of that, I will ask questions about prepare a simple balance sheet, prepare a simple income statement, and that kind of stuff. So all you really need to do to get a whole bunch of points is just understand where these elements go, and be able to say what an asset and liability and equity are, and give a couple of examples, things like that. It's not rocket science at all. Once you've committed to learning the basics. If you do that, you should be fine. Okay? So you can see this balance sheet starts off with the name of the financial statement. Usually the company's name is at the very top of the financial statement. So you would have the Albinus Agency, for example, or uh, whatever the name of the company is at the top of the financial statement, followed by the name of the statement, which in this case is the balance sheet, and the period that the statement covers. Now, let me just say that a balance sheet is really just a snapshot of the financial position at a particular day. Obviously, the next day, things are going to happen in the company, transactions are going to occur to change the balances the very next day. But the balance sheet is designed to give us a picture of what the company's assets, liabilities, and equities look like as at a particular day, usually at the end of the calendar year or fiscal year. Does anybody know the difference between a calendar year and a fiscal year? Anyone?
Calendar year ends the 31st of December, and a fiscal year is any year ending on another date.
Yeah, any year end other than December 31st. Okay, it's a nice thing to know. So if somebody is having coffee and saying that we're thinking about changing our fiscal year from the calendar year to another period, now instead of just continuing to move on because it doesn't mean anything to you. Now you can say, really, to yourself, I wonder why they're changing that. Hmm. And you may even question somebody, Susie, why are we changing it? And then they say, why do you want to know? You don't work in accounts. And you say, I know, but I'm a governance person because I'm responsible for good governance in here. Am I not? I'm just curious. And they say, why are you curious? It's because, and so on. Okay? That's the nice thing about having information. All right. So what are the three main elements of this balance sheet? Anybody knows?
The assets, liabilities, and equity.
Indeed. And we already know that the accounting equation says what? Does anybody remember?
Assets equals liability plus equity.
Indeed. So the accounting equation, please, if I ask you to write the accounting equation, don't get that one wrong. That's three easy points if I ask you. But the accounting equation says that all assets of the company are always equal to the liabilities of the company plus the equity of the company. And usually the equity of the company represents the investment that has been made in the company, either by the owner or outside shareholders, or both. Okay, it's a nice thing to know. Okay? Equity is made up of the investment in the company, either by the owner of the company or outside in the shareholders, or both. Okay, all right. Now, if you notice, assets in this particular example are broken down into what we call two groups. Does anybody figure out what two groups of assets we're dealing with? Probably not. If you notice at the bottom of the list, uh, beginning with cash going all the way down to the middle, you'll see total current assets, a particular amount. And then after that, we have some equipment and property and plant that we have also, that are also assets. And the reason why we have that is that assets are usually broken down into two parts. Current assets, meaning that we are going to basically use them up within a year in one form or another. And then we have fixed assets, meaning assets like plant and equipment and all that, and property and buildings. They are going to have an indefinite life going forward for a pretty long time until they're actually worn out. In some cases, if it's property, they do not deteriorate at all. So we have fixed assets and then we have current assets. For you guys, since you're not accountants, those basic fundamental things is good to know if you're looking at a balance sheet. And then you want to look at the components of the fixed current assets, for example. They're made up of a number of different types of accounts: cash, marketable securities, accounts receivable, money owing to the company, inventory that the company sells, prepaid expenses, and then other current assets, whatever they might be. So basically, these kinds of items constitute what we call current assets of the company. Uh, does everybody know what an accounts receivable is?
Money which you collected from debt sold.
Well, actually, you're very warm. It's not
Not yet collected.
absolutely. It's money not yet collected from debtors. Okay, people that you gave credit to when you sold them your goods, whatever your inventory was. In this case, you sold it on credit, and they have promised to pay you the balance of 1,677. God forbid that they will do that.
So why is that included if that ain't on it ain't if it's not in hand yet?
It's a good question, and this is one of the reasons why we have this discussion. For accounting purposes, even though you haven't collected cash, accounting requires that you account for the transaction so that you don't lose track of the transaction. You follow?
Okay.
Yeah. So we create an accounts receivable so there's a permanent record that somebody owes you money. Without that permanent record, you might eventually forget they owe you money. And they would be happy if you forget or you don't remember how much. or you don't remember the correct balance, or whatever the case might be. And so this receivable account is there. It has a permanent record that money is owed to the company until all of the money is repaid. Okay, it's a great question. Any other questions about current assets that you see that makes you curious?
Now
I
I
know.
remember last week we spoke about, remember we spoke about, I think debt or bill, I think liabilities that was accrued on a particular month, but then it might have been paid like 3 months later. How does that work with the accounts receivable? Is it the same principle? Like when we were talking about as to when those when do you log those outstanding debt?
No, debt is a very interesting word because uh, we account for debt depending on the type of debt. Uh, in this case, uh, in this case, the accounts receivable is not really a debt. It is
Okay,
owed by debtors. You
okay,
follow? Yeah. In this case, accounts receivable is an asset. The debt you're talking about,
The
yes.
accounts payable.
Yeah, it's a payable. All right. So in that case, the company is actually owing the money. You follow? In this case, the customers owe your company money. That's why we have the receivable account.
okay, okay.
Good point, because a lot of people confuse the two. All right. Any other questions about current assets? Okay. Now, prepaid expenses tend to be another question that persons get stuck on, not only students, even in the real world. Is it, well, first of all, what is it and why is it an asset? And usually what happens is when you go to the insurance company and purchase insurance for 1 year, let's say you pay the full premium, what you've done is purchase the use of that insurance for 1 year, correct?
Yeah,
Okay. So on the day that you purchase that insurance is an asset because you own the insurance, you haven't used any of it yet, and it's prepaid because you're paying it for the whole year in advance. Does everybody get that? So what happens after 1 month, you would have used up insurance expense for 1 month, but you still have 11 months of insurance owing to you by the company, insurance coverage. That's what I mean. Okay? And therefore, the month that is passed represents the insurance that is expired, and the 11 months ahead represents 11 months of insurance coverage that is owed to you by the insurance company because they have your money that you paid for it. So you purchase the asset, prepaid insurance, to cover the full year. And as each month passes, you use up a month, it becomes an expense. That's fundamentally how it works. All right. Don't stress if you don't see the big picture. Um, Accounting students battle with it all the time. The important thing is it's something you paid for in advance, and as long as it's in advance, you own it. When it's expired, then it becomes an expense. That's the simple version. Okay? Any other questions on current assets? All right. Then we have the other part of the asset category called fixed assets. I notice fixed assets are made up of plant and equipment if you're manufacturing stuff. And like any other asset, it depreciates. So we have this special account called accumulated depreciation. And as you can see, that account has a bracket around it, which means that accumulated depreciation decreases the cost of the asset every year, just like your car. No secret. Every time when you buy a new car, as soon as you drive it off the lot, it starts appreciating, correct? True or false?
it's true, but this particular one here, this is a negative. So that's just subtracting from the plant and equipment that you have there, or that's just a figure?
Well, if you subtract 664 from 2019, what do you get?
Okay.
By the way, you need a calculator for this class and for your final exam, for sure. You will be calculating stuff. When you subtract it, what do you get?
The 1355.
Absolutely. So we subtract the depreciation from the cost, and we have the new balance or cost of the asset. So if you buy a car for $30,000, in 1 year, it will not be worth 30,000 anymore. Does everybody get that? It would depreciate.
Yes.
Okay, by 10% or 15% or whatever the insurance company or the accounting profession says it's depreciated by. So if the insurance company says it depreciates by 20% in the first year, then after the first year of owning that car, it has lost 20% of its value. That's what depreciation is. So this 664 only means that this equipment has lost 664 of its value. And so now the new cost after losing that value is now 31355. That's all it is. And it'll keep going down every year until it gets to zero. When it gets to zero, doesn't mean it's worth nothing? Of course not. Okay. My car that I have depreciated forever ago, but I still love her to death. I won't get rid of her. And I'm hoping that when I decide to sell that girl, that somebody will give me what I want for it. All right, so it's lost all of its market value, but doesn't mean that it doesn't have any value whatsoever following the full depreciation. Okay, so that's just a little information there. What about note receivable? What do you think that is? Make a guess. It's another receivable, but it's long term this time. It's fixed. What do you think that might be?
Mm.
Say that
Well,
again?
That has something to do with like with the notes. We talked about last class, like when you owe somebody,
well, when something is owed, in this case, who owes
where
who?
so
Someone
in this
owes you.
case, they lend out money.
Yeah,
Right.
this company loaned money to someone or some company, absolutely, and the company's promised to pay them how much?
349.
349,000.
Eventually, over a couple of years, 2 years, 3 years, 5 years, whatever it is. So whenever there's a loan for more than 1 year, then we have to create a long-term or fixed account called note receivable because it will not be paid within 1 year. Everything that
Okay,
occurs,
if it is to be paid back in less than a year, what would that be called?
what category did I say that would fall in if it's less than a year?
Oh, I missed that.
Indeed.
Accounts receivable? No.
Yeah,
Oh, in
yeah.
the current assets,
Current assets.
Oh,
Yeah.
current, yes, okay.
Under accounts receivable. All right. So all current assets tend to be quote unquote used up or somehow negotiated within a year. Assets that live on beyond 1 year, we call them fixed or long term. Okay. And notice when we add the total current assets and the total fixed assets, what do we get?
the total assets.
Of
8,374.
indeed, indeed, indeed. Now, that's the asset side of the balance sheet. Now we have the liability side of the balance sheet, what we owe. All right. Of course, we know what accounts receivables, payables are. We owe somebody. What you don't know probably is the current portion of LTD. LT debt means long-term debt. Okay. Long-term debt, like the note receivable, is any debt that is older than 1 year. All right. In this case, we're showing the 1021 because that's the current portion of that debt. Let's say it's a 5-year loan, a 10-year loan. This 1021 represents the loan amount payable for the last year. Okay? That's why it's under current liabilities. Okay? Don't worry about how all that happened. The only thing you need to know is that the current portion of a long-term debt is a current liability. That's the point. So if I give you a question and one of the items happens to be, okay, current portion of long-term debt, please put it in the correct category in the balance sheet. You know that you should not put it under assets or equity. You should put it under liability. Indeed, because it's money that you owe. We all know what taxes payable are. We all pay VAT in one form or another. Accrued expenses, I think somebody may have been trying to allude to this particular category. Accrued expenses are expenses that are due but not yet paid. So you owe it, but you haven't paid it yet. Okay. So for example, if somebody works overtime and you haven't paid them yet, that's an accrued expense. You have to pay them during the next pay period. Until then, it sits under current liabilities as a payable because you owe the staff member or anybody else you owe. If you get a BEC bill for March and you're not paying it until April, you have to accrue that expense for March and then show it as accrued expenses because you owe BEC. That's how it works. Okay? So accrued expenses are always classified as liabilities. And then, of course, we have the total current liabilities, which equal
4,171.
total
Oh,
current
the total
liabilities.
current liabilities, sorry, 1839.
Exactly. But I'm glad you said 41 because students make that error all the time. All right. And so hopefully if this comes up in a test question, you won't make that error. All right. Any long-term debt on this balance sheet?
Yeah, why is that with the current portion?
Say it again.
Why is that different from the current portion which says long-term debt?
Yeah. This current portion under current liabilities is the current portion of the long-term debt sitting down below. And why is it current? Okay. Let's say anybody in the room has a mortgage.
Yeah, the current portion is what you would pay of your long-term debt, but within less than a year. And what is to be paid over a year for however long is the long-term part, right?
Okay.
Repeat that again. I don't follow that. Say it again.
I mean,
Say,
no.
say all that stuff again, whatever that was.
Okay, so you have a long-term debt. Okay, he was using the mortgage as an example.
Mhm.
So your mortgage will be, let's just say 50,000, your long-term debt may be 50,000, but your current portion of that long-term debt is what you have to pay within a year's time. So your current portion would be, let's say, the amount that you would have to pay between now and in the next 6 months, or however long you wanna say, less than a year, no?
Usually
So the
12.
long-term debt is, let's say the long-term debt, like the outstanding balance on the mortgage is like you have an extra 10 years and you have 50,000 over that 10-year period. This long-term debt would only account for that 12 months since it's just a 12-month balance sheet. So it'd be like $5,000 for that within that 12-month time. Is that what you're saying?
Correct. Basically,
Oh,
that's
okay.
what she's saying. So in this example, the long-term debt is 2332 from whatever 10, 15, 20 years, but the current portion, the amount that they paid as at December 31st, 2016 is only 1021. And every year,
So would that be deducted?
yes, definitely.
As in, so it would actually be the 2332 plus the 1021 then. But
If
the
you're looking
1021
at
is
your
showing up.
total debt, right, for that mortgage.
Yeah.
That's why I said be the 2332 plus the 1021.
Yes, theoretically, yes.
Okay.
Okay. Now, once you paid the 1021, then you would only have the 2332
Is the
left.
balance.
Correct. Okay.
Okay.
And so whenever you hear this discussion, now you know, and you don't have to be an accountant to first of all know this stuff, but also to use it to your benefit because this is something practical that you might see in your own lives if you have a mortgage or a 5-year car loan or whatever the case might be. Now you know that once it's longer than 1 year, it's a long-term debt. And for every long-term debt, there's a current portion that you pay, which is the first, which is every year you pay whatever the annual amount is until the balance gets to zero. Okay. And in accounting, we do this so that whoever's reading the financial statements can see what is payable for the year just passed and what the balance is that remains for the years ahead. Okay. That's all it means. All right. So when we add our total current liabilities and our long-term debt, what do we have? Total liabilities of?
4171.
Correct. Are we done with this balance sheet or there's something else we need to look at?
The equity.
Yeah, we have to look at the equity because so far this equation is out of balance, isn't it?
Yeah.
Yes, indeed. So there are three components, well, two really, that are shown on the owner's equity here. The first one is called common stock, which is the investment that has been made by the shareholders, 194. And then the other item account is retained earnings. Anybody remembers what we said retained earnings were? Retained earnings. Anybody remembers? Whenever you hear retained earnings, it means that is the amount of money that the company keeps in the company and does not pay out as dividends. You've all heard about dividends, yes?
Because it's kept to be reinvested.
Absolutely. Okay. So retained earnings is what is kept in the company for reinvestment to purchase any assets that the company might need in order to continue doing business
Or to pay the debt.
and to pay debt. Absolutely. Okay. So even though shareholders are sometimes screaming for dividends because they want to get some money because of out of their investment, oftentimes companies may not pay a dividend at the end of a particular year because they want to keep the money inside the company to make some important investments so that they can make greater revenue and greater profits. And if they can convince shareholders that that's what they're doing, then shareholders might leave them alone for another year.
So
But
you said
remember,
the first one, the common stock and paid in capital, that's what was earned as in when people buy shares or invested into the company.
what happens is the equity side of the balance sheet is made up of two accounts. The first account is common stock, which represents the investment in the company by shareholders when people buy shares in the company. For example, if any of you own shares in Cable Bahamas or JS Johnson or one of those companies, then you would be among that first group called common stockholders. Okay? And the other account that makes up owner's equity is the retained earnings, which is what is retained or kept in the business and not paid out in dividends to shareholders. Okay? And so when we add those two together, we get a total shareholders' equity of what amount?
4203.
Indeed. And remember, we said that in order for this balance sheet to balance, whatever's on the liabilities and equity side, they must be added, and it must be equal to whatever's on the asset side. Does that follow through in this example?
It does.
Indeed. All right. So if I give you some information next week and I say, based on this information, prepare a balance sheet, your job is to settle the balance sheet the way this looks and to put the various accounts in their proper categories. Do not put current assets into fixed assets and fixed assets into current assets. Do not put liabilities in owner's equity and owner's equity and liabilities. I'll be looking to see if you can properly classify these accounts in their correct positions in the balance sheet and then make it balanced or confirm that the balance sheet is balanced. Okay? All right, and for those of you,
What percentage is the final example is?
see, 1 second. I think I said 40% initially.
Yeah, you said 40.
Yeah,
Because the midterm is 40, you break it up into two. The midterm is 40 and the final is 40.
yeah, 40. Okay. Uh, but I wouldn't worry so much about it. Once you played around with this stuff a little bit, it really is not that difficult, at least especially at this stage of the game. You just need to know where to classify the accounts that I'll give you and then check to see if your account, your balance sheet is in balance. Uh, the way I do it when I'm allocating marks for this kind of question, I usually give a point for every correct expression that you make. So if you make a couple of errors and put things in the wrong area, you won't get credit for that, but for every category that you put in correctly, you get credit. So it's easy to build points if you skip one or two. Because sometimes students forget the classification, but that's just a function of who spends more time with it and who didn't have time to spend more time. But it won't be difficult at all. All right. The next statement that you can expect to get in pretty simplified form. This is pretty straightforward. is the income statement. And of course, this income statement is for what period?
The 31st of December.
Yeah, 31st of December, blah, blah, blah. Now, this income statement has two categories. Normally, in the real world, if you're reading an income statement, you won't see the budgeted side. That's normally kept internally for management. You'll see the actual side. So let's look at the actual side of this income statement for a moment. Forget about the budgeted. That's an in-house management thing, so that at the end of the year they could compare to see what actually happened compared to budget. So I want you to focus on the actual income and expenses and profit for this company. Now, does anybody remember what I said the formula was for net income, for net profit? Did I say? Did I give
I
you
don't,
that? I didn't give you that simple formula.
no.
The simple formula is this: income minus expenses equals net profit. That's it. Another simple formula. When expenses are greater than income, what do you think happens?
It's a loss.
Simple as that.
Loss.
You don't have to lose any sleep. You don't have to go to any expensive university. It's as simple as that. Now, having said that, let's go to the actual income statement for this company as at the 31st December. And this is the income and expenses for the entire year. Remember, the balance sheet looks at the position as at a particular day, end of year. The income statement looks at the totals represent activity for the entire year. So how much income did this company make in 2010?
94,600.
Indeed. And what did it make the income from?
Services rendered.
Yeah, whatever services, maybe massage or changing tires or whatever service it is, fixing hair, doing nails, whatever the case might be, they made 94,600. And then what kind of expenses were incurred? Salaries of?
Employees, right?
Yeah, how much was paid in salaries?
25,000,
25,000.
Yeah, and the telephone bill for the year?
1,500.
If it's 65,000, 6,500 for the year, how much is it a month on average?
Divide that by 12.
I hope so. Which equals?
$542.
Thank you very much. Uh, I just want to remind you that maybe a question might come where you actually have to divide. So don't be bashful. You will need your calculator. All right. The water and electricity bill for the year?
16,000.
Yeah. Any property taxes?
$1,000.
$1,000. I wish that was my property tax rate.
Yeah.
Uh,
Well, it might be that after the government give the 50% discount.
I hope so. Kiss my foot. I'll be jumping up and down. Insurance. How much is insurance for the year?
7,300.
Only 300.
Pretty hefty insurance rates. Sound like insurance rates in the Bahamas. On it.
Indeed.
But of course, this company has equipment and all that stuff. So maybe it's very expensive equipment, perhaps. And so the premium is significant. I hope that's the reason. After the last hurricane, I went into insurance company. I had a few, no major damage, just some shingles fly off, and maybe $200 or $300. So I'm good here. I'm headed in with my claim. I claim, and I said, "Excuse me, didn't you read the fine print that says that there is a claim? There's a claim.
Deductible.
Yeah, the deductible of doggone some 2% of something of the other thing. And I'm like, okay. And in my case, what that works out to be $7,000. I'm like, so my house have to suffer $7,000 worth of damage before you even consider my claim? They said, yes, sir. I'm like, okay, fine. Since I've never made a claim, do I get a discount on my premium next year? They said, no, you're going to pay more because you're paying for other people's damage. Any of you know about that?
No.
Oh,
Yeah.
yes. Oh, yes. After every hurricane, rates go up slightly.
Yeah, it doesn't matter whether you make a claim or not, whether you had damage or not. What the insurance companies do around the world in order to cover their losses in other parts of the world and in your country, they will increase the premiums on even those persons who made no claims whatsoever, whether it's for the hurricane or ever. And if you don't like it, drop dead. Find another company. The only problem is you go to another company, they all have a little oligarchy going on, so they're all doing the same thing. All right. Did this company advertise?
Yeah, 1,000.
Yeah. Whatever they spend fuel for, it amounted to what?
2,500.
Okay. The stationary bill wasn't too bad. Buying charges wasn't too bad. And then some other taxes. What do you think these taxes are?
The tax expense,
Yeah, the tax expense. What do you think those taxes are?
whatever, VAT, and whatever else.
Could be customs duties, VAT,
Or even income tax?
yeah.
Yeah. We know it's not property tax because property tax has its own rate and its own account. So this tax expense of 3,000 plus probably has to do with customs or VAT or income tax, depending on which jurisdiction you are in. So, what are the total expenses for this company then?
You said, what is the what?
Total expenses for this company for the year.
I just said that.
Did I say you need a calculator for this class and next one?
Mhm.
Mm-hmm.
63,780.
Okay. 63,780. Everybody agrees with that?
Yeah.
So if we take the total expenses from the total income, what do we have left?
The
Profit
3820.
or the loss. In
How
this
much
case,
do we have a
profit,
loss? Oh, in this case, it's a profit of how much?
30,820.
Indeed, indeed. Is that good or bad?
It's good because it's a profit.
Yeah, profits are always good. More profits are better, but profits are always good. Okay? It's losses that we're not interested in saying, no matter what amount it is. If you have a small loss of $1,000, you may not panic and close up your shop, but it does concern you that there's a loss to begin with, and it makes you wonder if it's going to be another loss next year and the next year. Nobody likes losses. We want to increase our profits all the time. That's why when things go the other way, companies tend to get rid of staff members first so that they could save tons and tons of money and bring up their profit margins. Okay? So oftentimes when companies send staff home, it's not only because there's a pandemic, but also because some entities are a little greedy. They just want to see their bottom line going up and up and up. And if staff salaries and benefits start getting in the way, then they start getting rid of staff. How about that? All right. The third statement that we will look at is the what we call the cash flow statement. Really, the cash flow statement just represents everything going into the company cash wise, all the cash coming in, and all the cash being paid out for whatever reason. Okay? Now, if you notice, this cash flow statement has three major categories. The first one is called cash flow from operating activities. The second category is cash flow from investing activities. And the third category is cash flow from financing activities. In each category, we have a representation of cash going into the company and cash being paid out of the company. So this is the account that persons would finally go to when the company is getting into trouble to see why there's no money in the bank, where did all the money go, what did we spend the money on, and that sort of thing. The cash flow statement will tell us these things. Did we make any investments? Did we borrow any money? Okay. Unfortunately, a lot of businesses, especially small businesses, don't pay attention to cash flow statements because they think once they make money, put it in the bank and they know the balance is, that's enough. Okay? But as your business starts to grow, get a little more sophisticated and cash starts to increase, any smart business person will take some time and sit down and talk with their accountant about what's going on in the cash flow account, if they have one in the first place. Okay? All right, so a couple of quick points. The cash flow statement is sometimes a little heady for non-accounting students and accounting students. So I'm going to attempt to give you a quick crash course um, in the cash flow statement without hopefully getting you to drink or pull out your hair. Um, Certainly, if I raise a question on this one, the question will not be a complex one. I will only want to see if you remember what goes on the cash flow from operating, what goes on the cash flow from investing, and what goes on the cash flow from financing, and do have a little rudimentary knowledge about what they are, in case you find yourself on a board or in a discussion about some governance issue where cash has been misappropriated and has been hidden somewhere else so that it doesn't show up in the cash flow statement, so nobody would know that the money was indeed misappropriated. But that's another matter. Okay, whether you know it or not, we have serious governance issues in accounting when CEOs and CFOs and others are unscrupulous, greedy bastards. They do all kinds of things on the financial and accounting side to mess around with the company's money so that they can move it from the company's bank account into their.
Personal.
Absolutely, do it all the time. Somebody's thinking about it as we speak. Okay, all right. So cash flow from operating activities, that's the income statement. Earnings really is what we call, is another word for net profit. Remember that net profit figure we saw earlier?
Mm-hmm.
The next name for net profit is earnings. So this company's earnings totaled how much?
248.
Indeed. And then remember we discussed depreciation. It's a loss in value in the assets. Um, except for cash flow purposes, depreciation does not represent money. And so what happens is we have to add back any depreciation into the cash flow statement because remember in the income statement we subtracted as an expense. So in the cash flow statement we have to add it back because it is not a dollar expense. Okay? Don't worry about all that stuff at this point. Just know for depreciation, if it shows up, you add it back. Okay. Now let me just say this. You notice already that some numbers have brackets and some don't.
Mm-hmm.
Okay. For our purposes, those numbers that do not have brackets, they represent cash coming in, and those that have brackets represent cash going
Cash
out.
going on.
Yeah. Okay. So earnings are 248 coming in, depreciation 239 coming in. Accounts receivable though is showing an outflow. Why do you think that would be an outflow?
Because
And
you
you,
don't receive it.
yeah, you didn't receive it. Okay. Every time you don't receive your money that is owed to you, that's an outflow for you and an inflow for who?
You said an outflow.
The debtor, the customer.
Yeah.
No, yeah.
If they don't pay you, who has the money? You or them?
Them.
Them. That's why they don't pay you. So if they don't pay you, that means it's an outflow for you because they still have it. Does everybody get that?
Yeah.
Okay. That's why it's a bracket. Inventory, we purchased 244. Inflow. Current assets, outflow. What do you think that means? Outflow for current assets.
I have a question.
Yeah.
Oh. Hold on. The inventory, it's on here from the operating activities because it help you to do whatever, like gain money in your business.
Absolutely.
Oh, that's you selling inventory.
Same thing.
Okay.
If you go into business and it's not a service business, you're selling goods, the most important asset is your inventory. Without that, you have nothing to sell. If you have nothing to sell, you have to close your doors. So yes, inventory are your assets that you sell to make money. By all means. Okay? Certainly. All right. So why do you think perhaps inventory is showing an inflow of 244?
Because that's something that was sold and you gain a profit.
Well, you haven't sold it yet because it's still an asset. You still have it. You haven't sold it yet. Remember when we sell inventory,
Mhm.
we reduce the inventory and we increase revenue, correct? That's why
Yeah, but
you.
this
Mhm.
I guess I'm confused on this one because it's saying the cash from operating activities as though this is the cash that you got from these services.
You're not confused. That's exactly what it's saying,
Okay.
right? With those without brackets means you get cash coming in from the activity, and those with brackets mean cash going out from the activity. So you're right.
Okay.
I'm just saying in the case of inventory, why do you think it's cash coming in? No bracket. Inflow. Why do you think it's an inflow on the inventory?
Because you sold?
Not yet. If you sold it, it wouldn't be there. Think about it this way. If you have a positive inflow for inventory, it means that you purchase inventory on credit. Does everybody see that? You increase your inventory, but you haven't paid yet. If you haven't paid, who has the money?
Or you?
So that's an inflow. Does everybody get that yet? It's funny. Remember with the receivable side, if somebody owes you money and they don't pay you, who has the money?
Damn.
Them. So that's an inflow for them, correct?
Okay, I get what you're saying now.
Yeah. And so if it's an inflow for them, it has to be an outflow for you because they didn't pay you. You don't have it.
So now in this case, it's an inflow for you and outflow for them.
Correct.
If you get it on credit.
Correct.
Okay.
So if you buy your inventory from the Albinus agency and you tell them, boy, I can pay you next week, then that's an inflow for you and an outflow for them. And they're waiting to get it. You follow?
Mm-hmm.
But until you pay, you have the money. And so that's money in your bank account, inflow. That's why people like to buy and sell on credit, because when they do that, they get to hang on to the money that they have or owe until they're ready to pay. And they do other stuff while you're waiting to be paid. Aha, interesting concept. Why do you think there's a bracket around accounts payable, outflow?
On accounts payable.
Yeah, outflow. Why is that bracket? Meaning money going out.
Because
Or,
that's what you owe.
yeah, that's what you owe, but there's an outflow in the amount of 107. What creates an outflow in accounts payable? Yes, you owe it. Does that mean that you increase accounts payable or you decrease it? Well, let me tell you, whenever you see a bracket around accounts payable, it means you paid a part of your bill. How's that?
Mm-hmm.
Okay, so money going?
Oh,
Absolutely. So who's happy in this case?
them.
Who them?
Whoever you owe.
Exactly. Just think about your own case, the same thing. Okay? If somebody owes you money, whenever they pay you, you're very happy. If you owe somebody money, and whenever you don't pay them, they're not happy. It's the same principle. All right. So when we look at those elements on the operating activities, then on a cash basis, we can then say that our cash flow from the day-to-day operations of this company is equal to 498. The question is, how do we get 498? Anybody knows yet?
You added up your inflows and
Right.
subtracted the outflows.
Okay. Did anybody do that to prove it? That's correct.
Hmm.
Repeat that for me, please.
Can you repeat that?
You added your inflows and subtracted the total outflows
And remember, how do you know what is an outflow?
from the bracket.
Absolutely. See, once you retain the rules of the game, it becomes easy to deal with. So, did anybody work it out to see if it works out? They made a typo, made an error.
Hmm. It right.
Okie dokie. So make sure when you are adding this particular category, you don't mix up the brackets and non-brackets. Okay? So in this case, is that 498 a positive or a negative number?
Positive.
Positive.
Of course, we got more inflows than we did outflows. Is that a good thing or a bad thing?
It's a good thing.
Of course, money in is always a good thing. More money in is always a good thing. You don't believe me? Go and collect that 300 bucks you loan somebody and see how good you feel. You can think about a million things to do with it. Companies are the same way. Okay. All right. So what's the next category we're going to look at on the cash flow statement? What is it called? Cash flow from what?
Investing activities.
Okay. What investments did this company make?
Purchase
Plant.
of equipment,
Yeah, it purchased a plant and equipment for how much?
205.
How much?
205.
205.
400.
200.
205.
Yes. Sounds like I may have a dyslexia patient, student in my group. 405. Be careful. I know it happens, okay? Numbers are tricky, especially at the end of the day, especially if you're busy, especially if you're trying to get to an exam. So be careful. You check and double check your numbers because sometimes we do weird stuff, we're not aware of it until after the results are in. Then we say, I could have sworn I got that right. In fact, I swear. And then you realize, my God, did I really miss that? Okay. I've had students who've left entire questions out of an examination, or two entire questions. They knew the answers, they just missed the questions and the excitement, or whatever the case may have been. All right, so be careful. So yeah, this company paid 205 for the property, plant, and equipment. Any other investment?
Long-term assets.
Yeah, long-term assets.
What would that be, like maybe interest received or something?
Why not? I mean, it could be. For one thing for sure, we know it represents a what?
An inflow.
Yeah, it represents an inflow. Or it could be an investment in the stock market, the bond market, or any other type of investment where you're getting a return such as interest, dividends, and so on coming into the company. Right? So that, yeah, that's a good point. It, the important thing is whatever that long-term asset is, whether it's a bond, a set of stocks, and other derivatives, whatever they might be, they represent a return on the investment that is positive, in this case 20. And so therefore, when we look at cash from investing, do we have a net inflow or outflow?
Outflow.
Why is it an outflow?
Because you paid out more than you got back in.
Yes, we paid out more in this particular year than we got in. Okay? It's not complicated once you get the basic concepts and rules and hang on to them. And then the final activity in this year is cash flow from.
Financing activities.
And in case you didn't know, financing means borrowing. Anytime you finance anything in your life, a company's life, or any other life, it's called borrowing. So in this case, what kinds of things financing was done by this company? Well, it has a credit line, meaning it has an overdraft facility of 50. That's why it's bracketed, because it's a negative 50, because it's an overdraft credit line, all right, which is an outflow. Why is an overdraft an outflow?
Cause that's
You
you in the negative, you gotta cover that.
Yeah,
Gotta pay that.
exactly. I like that. You use up 50 or whatever, thousand, million, whatever it is, and now you have to find money to deposit until I get back into a positive balance. That's what overdrafts and credit lines are all about. So you don't say, yay, I love this, let me go to Vegas and have fun, buy a car, cash, and all that nonsense. You can't do that unless you know where the money's coming from to cover that credit line or that overdraft. Otherwise, you're going to be in trouble. And some companies do find themselves in trouble because they do nonsense. And people. All right. What about this current portion? Why is that financing?
Why is it $1?
Is it really $1?
It's $8.
I know. I'm glad you raised it. That's why I didn't say anything.
You might as well didn't put it on there.
Yeah. But it isn't really $1. This particular statement is in thousands of dollars. So that one wouldn't really be $1. For example, let me show you what I mean.
Yeah, that would represent 1,000.
Yeah.
If the financials are being reported in thousands, which means all of these numbers here are actually thousands.
Indeed. Okay, so that is why I'm glad you actually remembered, bothered to say that, because now we can throw that in there, because a lot of persons still get stuck when they see a balance sheet and you see thousands of dollars at the end. And so we leave off the zeros. That's what we do. Does everybody get that?
That's why the zeros on the side of the 2016.
Yes. So let me give you an example. If you look at total current assets on this balance sheet, what is it?
So that'll be 80,374 then.
Total current assets.
We are
No, that's 8 million.
8,374,000.
Yeah, that's
Okay.
8,374,000.
I'm sorry. I should tell you. Total current assets on the balance sheet.
Oh, that'd be what, 6,670,000.
Exactly. Does everybody get that?
Yes.
Okay.
Yes.
Yeah.
Great. So if you pick up a balance sheet, income statement, you see thousands of dollars. In the statement itself, they will leave off the zeros sometimes, not always. Some companies show all the zeros.
So those zeros, you just add the zeros behind whatever figure then.
Yes.
Okay.
Okay. We just leave them off for convenience in this example. But you could easily see a financial statement that includes all the zeros. Okay, folks? All right. So it's not really $1, it's what?
1,000.
Yeah, from what we see, it looks like it's
Yeah.
$1,000. All right. Why is that a financing activity? This current portion of a long-term debt.
That's what you paid on your long term.
Yeah, that's the amount that you're paying for the year on your long-term.
How come that's reflected as a positive number though? Why is it that not in brackets?
He say, remember when he gave talk about the car insurance? So you have a year. It goes down by the month. So if January go, then you still have 11 months of that $1,000.
Well, this one, well, that's kind of, but this one is a little different, and that original question is a good one. Why is it a positive number? Well, we know that no brackets mean what?
That is.
Inflow.
That is an inflow. That's why I'm
Inflow.
asking you.
Inflow, right? Now, if it's the current portion of the long-term debt, that means it's not paid yet.
Okay.
Yeah. If you see current portion of a long-term debt and there are no brackets, it means it has not yet been paid. It will be, but it's not yet at the date of this statement. Does everybody get that?
Yeah.
That is the beauty of this bloody cash flow statement that a lot of people don't like to mess with. But in this cash flow statement are all kinds of jewels about what the hell is really going on in a particular company. And I suspect if some people were diligent enough to go and really look at a cash flow statement in a particular company really closely, they might find some interesting things that they didn't expect. All right, any other financing?
The long-term debt,
Yeah, which is the long-term portion of the current portion, correct?
yeah,
Notice this one has a bracket, why?
because that's what you still
Oh,
owe. Mhm.
absolutely. Any other debts? Financing?
Say other long-term liabilities.
Yeah, but no brackets this time, why?
Because you don't pay it out
Yeah,
yet.
you don't pay, and she laughed, I like that. That means you get this concept completely now. She said, mother sick, I get it now. They didn't pay, that's why it's positive inflow, okay? Because if they had paid it, it would be a what? Bracket. And remember,
Mhm.
companies are just like people. When it's time to pay, we don't want pay. True or false?
True.
Yeah, speak the truth and shame the devil, my grandma used to say. Absolutely. Companies are like people. They only pay when they have to. I have a guy do some consultancy work for. He loves when it's time to give me work. Stuff is ready for work. But when it's time to pay, what do you think happens? He's not excited anymore. I'm like, the work is done. Is the check ready? He said, and I said, how are you today, sir? He said, I'm bad. That means he doesn't really want to pay you right away. And that's how folks are when it's time to pay. All right. Any other financing for this company?
Mm-mm. Oh,
No?
equity,
What do we
the
call the equity?
dividends,
Yeah, this company paid dividends. Hence the brackets. How much they pay in dividends?
166.
Who they
Mhm.
paid it to?
Whoever qualified.
Who
Well, the
qualifies?
shareholders, the shareholders.
Shareholders,
Yeah, the fellow, not whoever, only
No, as I said, the
shareholders.
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 Yes. Okay. So, as a result of all of that financing activity, this company's been busy, by the way. The cash flow from financing is actually equal to,
And then the negative, they're in
which
the
is,
red,
which is
302.
indeed. So now if we add up cash from operations, cash from investing, and cash from financing, what do we get? Totals. Add them.
11.
11. Does everybody see that?
Mhm.
So even though a lot of money was paid out for investment and financing, the company is still left with some money. Not a lot, but some. Okay, which is a good thing because being in the positive cash flow is always good. And so cash change in cash at the end of the year was 11, and we add what to that 11?
The
Cash
cash
at
at
the
the
beginning.
beginning.
Cash at the beginning, and so therefore the total cash for this company at the end of the year equals
83,000.
83.
absolutely. All right, so it's not difficult. The only thing I can do is give you some items that go under cash from operating or cash from investing
So
or
question, cash at the beginning would be what your cash was at the previous year and then.
correct.
Okay, because I was wondering where that came from. Okay, so whatever your cash was at the previous year, and that would be your beginning cash for this period that you're doing the statement for.
Correct, which is the end of the year again. So remember, because remember, this statement is as at the end of the year. So at the end of the year, you have $11,000 left in cash, and then for cash flow purposes, you add what you had at the beginning of the year. So that means your total cash position is now 83,000. Okay? And we do that every single time. All right. So uh, if I raise a question like this, don't panic. Just say, okay, we only have three categories. What the hell is these go into? So you have to study a little bit so you can be familiar. I'm not gonna necessarily ask you like all of them. I'll just pull out a one, two, or three and say, and for each category, and then you just put it in as an inflow and outflow. Do your arithmetic, and don't forget to make the adjustment at the bottom, and that's it. Points galore if you do it right.
Mm.
What's the opposite of galore? Anybody know?
None.
None. No point. No, no points if you don't. Or fewer points, let me put it that way. Because you can't, God forbid, you can't get them all incorrect. You have to get some right and maybe egg some up if you slip up a little bit. But the goal is to get all of them correct, or as many of them as possible.
Where
All
do,
right, question?
Mm.
All right. Again, this is another income statement. You can look at that and have fun with it. It's pretty much the same structure as we saw earlier, with one or two items in it for you to dribble. For example, under net income, we have an account called what?
Under net income, you said?
Yes, in this statement.
preferred dividends?
Yes. How much are the preferred dividends?
100.
$100?
Oh, sorry, 100,000.
100 is understood. I just want to make sure you didn't miss that thousands of dollars thing. Okay. But when you say 100 to us, now we know you mean 100,000. Okay. All right. So instead of paying dividends to common shareholders, all we did was pay dividends to preferred shareholders. No big deal. We subtracted. And then what's the balance after preferred dividend payment?
3,340.
Indeed. Did we pay any dividends to common stockholders?
500.
Yeah.
100.
So after we pay them, what's left in retained earnings?
200.
How much?
2840.
If we didn't pay the preferred shareholders and common shareholders, what would have been in retained earnings?
3340.
If we didn't pay preferred dividends and common dividends, what would have been in retained earnings?
3440.
Indeed. Indeed. Just want you to get used to roaming around the stuff and picking up the correct numbers. All right. So retained earnings then after dividends to preferred and shareholders, 2840. Any retained earnings at the end of the year? Sorry, at the beginning of the year?
The 12,000.
12,000.
Yeah, remember whatever's at the beginning is from the end of the year, previous year, just like the cash. So at the beginning of this year, it's 12,000. And at the end of the year, what do?
You add them.
Yeah, you add them. So the retained earnings as of December 31st becomes?
14,840.
So with regards to retained earnings, are you better off or worse off?
Better.
Better off.
Of course, anytime retained earnings is increasing, you're better off. When it's decreasing and decreasing, then you know you're probably paying out too many dividends. You need to, whoa, because you may pay out more money than you need to and not have enough to do what? Invest
Run
in
your
it.
business.
Yes, yes, yes. Okay. Remember, the company has to constantly make investments in current and fixed assets over time, from day to day, year to year. So you have to always be watching your cash position to make sure, it's just like your personal life. Okay. You can't spend all of your money and not make an accounting for maybe the car will break down. And worse still, when you take it to the bush mechanic, he tells you that'll be $750. And you're like, oh my God, $750? I'm going to commit suicide, tell my family I love them or something. See? Companies are like that as well. They need to make sure that they plan to meet these commitments. So you can't pay everything out to people like owners, even though they own the company by shares. You still have to be able to say to the owners, we can't pay you all the money. We need to keep some to do business. Okay. Any questions? All right. So those are the three statements that you're very likely to be asked a question on. So I encourage you to familiarize yourself with them, so that any elements I throw out and ask you to prepare those statements, you can just close your eyes, take a sip of coffee, and that's it. Tear into it.
The balance, the income, and the cash flow.
Indeed.
Okay.
Did you say the balance?
Yeah.
What is the balance?
The balance sheet.
Oh, the balance sheet.
Mm-hmm.
Remember, for accountants like me, the balance is not the same as the balance sheet.
All
How's
right, because
that?
you said three statements, so I'm just trying to.
I know. I'm just
I
teasing
get what
you.
you're saying.
Yeah, when you say balance, I knew what you meant, but I also wanted you to be encourage you to say what?
Balance sheet.
Indeed. Get used to saying it. Balance sheet.
Are
Income
we
statement. Question?
getting this trial balance too?
What trial balance? How do you know there's a trial balance coming up?
I ask him because we talked about it last class.
We did. Again, I'm just being the devil's advocate. By all means, the trial balance is the easiest of all the statements. So if I ask you to prepare a trial balance, you should just knock yourself out. Does anybody remember what I said about how to prepare a trial balance? How do you do it? Simply, in a nutshell.
You simply list, I mean, all of the balances from all of your ledgers, whether they be debits and credits, are just listed.
Yes, then when you've listed
In two
them,
columns, A.
yeah, the same two columns that we looked at. And when you've listed them, what do?
They should
Total
both
up,
balance.
balance.
How do you know they're going to balance?
Like
How do you what?
for every
Total up.
debit, for every debit,
There should be a corresponding credit.
In other words, you have to add them up.
Add them together.
Yeah, add up all the debits, add up all the credits and see if they're equal. If they don't equal, what do you have to do?
Go
Go
back
back
again.
and check it.
Yeah, try not to use all your exam time checking it though. If you spend 2 or 3 minutes and you don't find it, leave it. There's other important things to do, correct? Remember, examination is not all knowledge, it's part technique as well. Okay? Knowing when to quit a particular question and move on to get points for all the other ones. Don't spend all your time messing around, you know? It's like dating a married person. Is there any value in that?
Hmm?
Mm-hmm. Because you're messing around and then what?
mm-mm.
Nothing. So it's like that. If you're trying to find the error and taking you too long, and man, the hell with that error. That's only 1 or 2 points anyway. The devil with it. Move on to the stuff to get points. That's the point. All right. So yeah. So 4 statements then potentially. Also, you can expect to get some sample journal entries. Remember we did some journal entries?
Yeah.
Yeah, I'm gonna ask you to do some of them. I'm not gonna ask you to do any big time out of this world stuff that we haven't talked about. So whatever I ask you will be along those lines. So you just need to know them. What to
So we
them.
getting questions. So like, knowing like definitions and stuff.
Yes, the examination is gonna be definitions, short answers, and a couple of problems. What will the problems be? Preparing financial statements. What will the short answers be? Things like who uses financial information, who are the auditors, what different types of audit opinions, which we're going to talk about in a little bit, and stuff like that. So you're going to have 3 categories. Definitions, like what is the accounting equation? What is a ledger? What is a general ledger? Things that you ought to know by now. And then short answer questions, and then a couple of little problems at the end, which will be primarily the preparation of financial statements, the same ones I discussed. So you know there can only be 4 of them, and each of them have their own unique features. And if you practice them over and over a bit and wear yourself out, get totally bored with it, then you'll be ready. Any question. But if you just look at it quick, I think I know, then you might find that you don't know. You have to spend a little time solidifying it. All
This
right.
question is if for some reason what would be the weight of the actual practice questions in relation to the rest of the paper? Or are all questions weighted equally?
No. More generally, I ask 10 to 12 Definitions, 1 point each. I ask maybe 10 short answer questions. That can be anywhere from 1 point to 3 points total. And then the financial statements, you'll get 1 point for every correct answer you give. And that you put the heading on the financial statement. If you do not put the heading on the financial statement, you might lose 2 or 3 points just for not putting it there because it's important. So that's basically how it works. So the more information you put down correctly, the more points you get. And that's the objective. Okay. You want to make sure you maximize the information that you get correct versus those you might miss. Okay. And basically, if you just keep going over and over this stuff until exam time, you can't go wrong. It would be impossible. All right. And don't stop going over it until you're bored with it. Just looking at it, you could just remember stuff. Just thinking about it because you're already labored. Okay. I know some students tend to try and take a little shortcut. I'll do a little here, a little there. You know, whatever. None of that stuff. Once you dig into it, practice it, take out the numbers and redo them, see if you got it right, see if you got the elements in the right place, put the cash flow statement elements in the right categories, cover it up with your hand, redo it, whatever works for you. Do that. If some people can get it in 3 hours and they're ready to go, the devil with them and the hell with them. They're smart, we say. But if you need to take like 17 hours, so what? Put on your pajamas and do the 17 hours. Because at the end of the day, your objective is the same. To pass and pass as well as you can. How's that? All right, why are financial statements important? Just pretty much basic reading. The income statement tells you about the results, whether you made a profit or loss. The balance sheet shows what the financial position is as at the end of the calendar or fiscal year. Management often uses information in order to make decisions about how to spend money, what assets to purchase, how to increase profits, and all that stuff. These are just some of the small, key, important reasons why statements are important. Okay. Financial statements are also important because staff is looking at them, investors are looking at the company, creditors who lend you money are looking, and the government is looking because they want their taxes paid. Okay. So everybody's interested in these financial statements for one reason or another. Okay. Which is why we've been saying all along, financial statements should be as simple as possible, even though many of them are not, so that these people who need them from all walks of life, including shareholders like yourselves, for example, who might purchase shares in a company, when you look at these statements, you can have some idea of what you're looking at. If you sit on a board discussing governance issue, you have some idea of what's going on at the table, and you may even object to something because something doesn't look right. Okay? That's the purpose of this stuff, okay? In case you were wondering. I don't think any of us do not know what a budget is. I hope we all know what a budget is. We certainly should know what a personal budget is, but companies prepare budgets too. You might know because you might work for a company, financial institution, or other company where you might say we need certain things or we need an increase, and your manager says it's not in the
Budget.
absolutely, which means go away.
That's all I mean.
Yeah, that's all it means. Go away and don't come back until we tell you it's in the budget. And if so, they never tell you. It might be, but still, it's not in the budget. All right, famous expressions for managers and executives is not in the budget. All right. So, and we all know that a budget is just an estimate of revenue and expenses, an estimate of anything. What actually happens in practice in the real world for that year, nobody really knows until the year is over. But we try to budget things so that we could gauge it, see how much we were over or under, so that we can kind of control our expenses and how we spend our money. That's all budgeting is all about. Okay? Now, the different types of budgets you should at least be aware of. In case you haven't heard about them, we have a master budget. What do you think a master budget is? Master budget.
The whole overall,
Yeah, the
or
overall.
what you expecting?
Well, a little more than what you're expecting. The master budget, notice that word that I have underlined. What word do I have underlined?
Aggregate.
What does that mean? When we add everything together, that's what aggregate means. So if you hear the expression at your next board meeting or anywhere in the aggregate, it means that somebody's talking about adding the total of a number of things together, right? And so the master budget is an aggregate of the company's individual budgets, which we'll see in a minute. So we do individual budgets, and then we add them all together and put them in the master budget so that the board can see the big picture without having to look at all the individual bits and pieces of budgets. Bits and pieces of budgets are for other people like managers and supervisors who manage things from day to day. The board does not want to be stressed over the individual detail. Thus, the master budget is done to look at the big picture and make decisions based on that. Okay? So you can see where your short answer questions are going to come from, just like that. Or definitions. Okay? I could easily say, list and describe 3 types of budgets that you might find in a particular organization. And then if you've studied, you wouldn't panic. You say, man, I know that crap. You're not going to get me with that. Because I studied that. I studied all over and over and over. So whatever question you ask me will be a piece of cake. That's the idea. What is an operating budget? Anyone? What period does it cover?
The year,
Yeah,
12-month period.
Yeah, 12-month period. About the day-to-day operations. We try to forecast and analyze what income expenses we made over the year. What about the cash flow budget? What's that?
Is a means of projecting how and when cash comes in and flows out of a business within a specified time period.
Indeed, which is a good thing as well. Because see, the operating budget doesn't necessarily talk about all the cash issues. It just talks about revenue and expenses. And we know that some revenue doesn't represent cash, right, folks? Right?
Repeat what you said?
All revenue is not cash.
Oh, okay.
True or false? See, it's a true or false question. What would you put in the exam?
True.
It isn't.
It's
Is
true,
that true or false?
So that's
true.
true.
True, yes. True, full stop. I had a student once, I said true or false question. They said true based on certain conditions. I'm like, okay, whatever. But you don't have to put anything behind the true or false. It's either true or false. Okay? All right?
I'm glad you say that now.
Absolutely. Absolutely. Because sometimes we just tuck stuff behind it as if that will change the outcome of the answer. Usually it does not. Right? Any other budgets?
Financial and static.
Yeah, what is a financial budget?
Presents a company strategy for managing its assets, cash flow, income, and expenses.
Yeah, so it's kind of a combination of the balance sheet and the income statement and how we manage them. A static budget, we are told, is what type of budget?
Fixed.
Yeah, it's fixed. Once we fix it for the year, that's it. No changes. You run out of money, the hell with you in your department. There's no more money. You should have budgeted better or whatever they tell you. What do you think is the opposite of a static budget?
Fluid.
What's the opposite of a static budget? What's the opposite of fixed?
You said the opposite of what? The static budget?
Yeah, what's the opposite of fixed?
So the current budget?
Not current,
Actual?
not actual. If something is fixed, what's the opposite of fixed? You probably have a
Flexible.
flexible.
It's
Somebody
movable,
said
but that's not,
flexible.
oh, okay.
Okay. If your company has a flexible budget, what is your company saying to everyone?
We got money to throw around.
So yeah, sort of. Well done. That's the real world expression. But the textbook version of it is we're prepared to make adjustments if necessary. But for some companies, what it means is yes, we have money to throw around, so to speak. All right. Nobody wants to hear it put that way though, even though oftentimes that's what it means. All right. So the next page is really, it looks complicated with a bunch of zeros, but really it isn't. It is a simple budget. Okay? And it's a simple budget of what kind of statement, anyone? What kind of statement is this? Of the 4 statements that we did.
This is the balance sheet. No. Hold on.
Somebody's still saying balance without the other part of the balance.
Balance sheet. Sorry, that's still me.
Thank you very much. Remember, I know what you mean. However, I want you to say it.
Is this an income statement?
Yes. Why did you put it in form of a question rather than a statement?
Income statement.
Indeed. Okay. Don't be afraid to be emphatic. And it's an income statement. That's what it is. Yes, it's an income statement. And it's an income statement, budgeted income statement that is divided into 2 parts, a summary and details. Correct? Now, the reason why I'm saying like correct and stuff, because I'm making the hell of assumption that some of the students actually looked at this. But students don't typically look at it all the time until D-Day. Because they look at all those numbers and say, man, I'm tired. It's been a long day. It's been a long day in church. It's been a long Saturday in the mall. I can't be bothered with that right now. All right. So what is the summary? Total income minus
Expenses.
equals.
Either your profit or your loss.
So the actual profit, was it an actual profit or loss?
Profit.
Yes, profit. Were we over, was our profit over or under budget?
Over.
Over. Over. Were our expenses over or under budget in the summary?
Expenses.
Under.
Under?
Yeah,
Under? Under?
our expenses.
Over,
Over.
over budget.
You say expenses, right?
Yeah,
Yes.
over budget. The budgeted expense was 314,000. The actual expense was 339.
Yeah, so we over.
Hold on. I am the wrong thing. Eh?
No,
It's still at the top.
we
It's
still
still
at
at
the top.
Oh,
it's
you're in the
summary.
summary.
Yeah.
Yes.
Okay, sorry.
Okay. All right. So be careful. It's not hard, but if you were out in left field and you missed it, come test time or any other time, even in the real list, man, I should have been listening to that. I would have remembered that fact. All right. So the
So
rest,
just a quick question. So why don't we, with that question, why didn't we look down in the expense details?
well, we could. As a matter of fact, we're going to look at the expense and income details now. Because remember, the details is just the details of what?
What actually happened?
Yeah, the summary.
Yeah, okay.
So the details would just be a
It breaks it
breakdown.
down. Okay.
Yeah,
Valid point,
but at
valid-
the end of the day, it's still going to work out to the
That's it.
same thing that is in the summary.
Okay, no problem.
Okay. So have fun. In the income details, sales are over under budget.
In the income details, say it again.
In the income details, sales are
Over.
over under budget.
Over.
Commissions over under.
Sorry?
Over.
Commission.
Under.
Under.
Okay.
Commissions was under.
Royalty.
Commissions.
Royalties was under.
By how much?
100.
100.
100. All right. Let's go down to the expenses. Most of the expenses were over under budget.
Under budgeted.
Is that good or bad?
That's bad.
No, bad.
Bad, because we didn't
Bad.
prepare for it.
Would you want your expenses to be?
No, it was under, so it's
That
good.
was good.
It's actually good because
You didn't spend as much
spend
as you
on-
thought you was gonna spend.
right.
Now we are thinking about it rather than just going through the motions. Yes. Those under budgets are good because you're spending less than you propose to spend, which means you have more money in the
Bank,
Yeah.
in the
company.
the same thing applies to your personal life. If you do a budget and you spend less, you're ahead of the game. If you do a budget and you spend more, dog eat your lunch. The same dog that's barking, by the way.
Actual,
Or somebody caught that. All right. What about wages and salaries? Over, under?
Wages and salaries.
Under,
Over. And that's to the bottom?
no, under, you save $2,000.
Kiss my foot. Are we looking at the same budget? Everybody's saying something different.
I gone to wages and salaries to the bottom, so. my
No,
bad.
wages and
But
salaries was
Salaries
over
at the top,
under budget by
$2,000, right?
$2,000.
Under or over?
over.
Over.
Which one you referring to?
on.
Oh,
Right
okay,
there
there's
under
two.
administrative.
Administrative, okay, but there are two salaries and wages under selling.
And what's the difference between the two?
One represents selling expenses, like people, the marketing people, and the other represents the people who work in the office, the typists and other administrative people.
We didn't know that.
So,
So it balances itself out then. 2,000 under, 2,000 over.
You could look at it that way, but we're not balancing it out. We're looking at it individually under administrative.
so if you ask that question, would you say under administrative?
Certainly.
Okay.
All right. But I picked the administrative salaries for a reason. Is it over or under?
Over.
It's over.
What does over budget mean for this expense?
What does what?
You see?
No, they
They
wasn't
spent
prepared
more.
for it. They budgeted
Spent
for
more.
10,000 and it was actually 12,000, so they were short.
So is that good or bad?
That's bad.
That's bad. They didn't prepare for it.
That's, but you can't always prepare, but it turns out to be bad anyway. If you spend more than you plan, may not be bad, because maybe that 2,000 represents overtime that brought you some more business or whatever. But the point is, it ends up being more than you plan to spend. Just like in your personal business, okay? If you say I'm budgeting for lunch, $5 a day, that's $25 a week. And doggone it, one day you decide to buy some oysters or something from the Japanese place somewhere, and suddenly you're out of budget. So by the end of the week, when you do your comparison, instead of $25, you find that your lunch for that week was $75. Would that make you feel great?
No.
Hell no. And so on a
It's
company,
fun.
sorry,
No, wouldn't feel great.
but it was fun while it lasted. Companies do the same thing, by the way. All right, sometimes to their own detriment. Okay, so we're getting down the stretch then. What is an audit? I think most of us know that audits are an independent examination of the financial statements of a company. When auditors come in, they're looking to see if you did the company financials, those same 4 statements properly, according to generally accepted accounting principles. If they find that anybody was thieving along the way, thieving is Bahamianese for?
Stealing.
Yes. All right. If they find any fraud or theft, they will bring it to management attention, but they're not really there to find fraud and theft. They're there to check the financial statements to make sure that they meet generally accepted accounting principle standards. Okay? In case you didn't know. But if they find any hanky-panky along the way, then they must bring it to the board's attention. See, that's part of the governance process. That's why companies are audited, because the accounting department is inside the company. They do have to do whatever management says. Auditors are independent CPAs and accountants who have their own outside firms, so they don't have to do anything what management says, unless management tries to bribe them, and they take a bribe. Because money, my grandma used to say, is the root of all evil, even for auditors. Because some auditors have been found to be taking bribes and therefore coming up with stuff in the audit that was not correct, hiding stuff on behalf of management, covering stuff for money or for the opportunity to come back and get a multi-million-dollar audit next year again. Should they do it? The answer is no. But every now and then people get a little greedy, get a little unethical. Those millions start to make their eyes glitter, and therefore they start engaging in unethical behavior. Okay? What is the difference between auditing and accounting, anyone? Good test question. What's the difference? Accounting does what? Accounting does what? I don't mind if you read it off the text.
Record the daily financial activities of the company.
Yeah, remember those transactions we recorded? Remember those?
Mhm.
Those journal entries? Remember those postings we did? Remember that general ledger I showed you? That's accounting. And the trial balance, that's accounting. And the financial statements, that's accounting. Auditing does what? It comes back and check all that stuff.
Review the financial information.
Yeah, auditors come back and check all that stuff to see if we did it right. Okay, folks? In case you were wondering, don't let me ask that question in a test and you don't answer that correct. Okay? And what is the objective of the audit? So that an opinion can be expressed on whether the statements are prepared in accordance with generally accepted accounting principles or international standards of auditing. All right, so basically they come in with a predetermined set of programs called audit programs, test your financial statements to see whether your accounting department did the job properly. If they did, the auditors would issue a favorable opinion. If they did not do it properly enough, the auditors will issue an unfavorable opinion. Nobody wants an unfavorable opinion. Right? That's why auditors have to be independent. They have to have the technical skills with GAAP, generally accepted accounting principles, generally accepted auditing principles, so that they can do their jobs well, just like any other profession. Okay? All right. Who do the auditors report to? The shareholders, not the board. Why do they report to shareholders? Anyone?
In
Because they
case the
need to be
board did something.
unbiased.
Because the shareholders are the owners of the company, not the board of directors. Even though some board members act like they own it, they don't. When auditors come in and the reports are done, the reports are addressed to the shareholders of the company. The shareholders will then sit with the board and say, you've had a successful year or not. The auditors have reported that you've done well or not. And since you didn't do well this year, I'm firing some of you or all of you. The shareholders might say at the shareholders meeting and get a new board. Just like how management fires employees and get new employees, shareholders have the right to fire boards if they want to, if the audits are not right, if the auditors come up with too many damning problems. By the way, the expression damning problems is different from damned problems. Okay? It's something for you to dream about if you're interested. They don't mean the same. In fact, they mean completely different things. All right? So the auditors come in, do their work, make a report to the shareholders. There are all kinds of audits, compliance audits, like if you're supposed to present VAT reports on time, did you do it? If you didn't, you're out of compliance. Auditors come in to see if you did the numbers right. Construction audits. Remember, people go down to construction sites to see if you're putting in the right concrete, you're following the plan, you're not taking any shortcuts. Okay? Financial audits, we looked at that earlier. The audit of the financial statements. By the way, what are the 4 financial statements that we looked at? Anyone? Anyone? I'm the only one who remembers. What are the 4 types of financial statements that we looked at?
Can you repeat the question, please?
What are the 4 types of financial statements that we discussed?
The balance sheet,
Balance sheet,
Okay.
income and expense
Income
report,
the income statement,
Mhm.
statement of cash flows.
Cash flow
and the
statement.
trial balance.
And the trial balance, yes. Okay. So we can move on. The information systems audit is an IT audit. Auditors come in to make sure the IT people are doing things right, the correct firewalls in place, the servers working, their offsite facilities in case of a disaster and so on. Okay. An investigative audit is if any investigation needs to be done because there's a feeling that there's fraud, theft, and all that stuff, auditors and others will come in and do an investigation, even the police maybe to some extent, if necessary, to find out what's going on. It's called an investigative audit. An operational audit is usually conducted by internal audit, checking the day-to-day operations to see if everybody's following the policies and procedures of the company. And if they're not, the internal auditors will write you up. And departments that get write up too much do not stand in good favor with management, and whoever's head of that department, if they don't fix it, they might find themselves either in another department or at home looking for another job. Okay? Tax audit is almost self-explanatory. A VAT audit is a tax audit. VAT auditors are moving and roaming around the Bahamas as we speak, checking companies to see if they reported correctly and they didn't lie on their VAT returns. Suffice it to say that some people always lie on cash tax issues, and so they've had to pay the extra tax that they were trying not to pay. So the tax audit is about. All right. So if I ask you to define any one of those audits, it shouldn't be a difficulty. They're pretty straightforward. What are the four types of audit reports you need to know? Well, there are four of them. If you have to learn them by heart, that's fine, because I might ask you to list them. And if I ask you to list them, I expect you to say that the four types of audits are unqualified, qualified, adverse, and a disclaimer of opinion. All right, so you need to know those four types of audit opinions. Because if you're in a board meeting and you're a board member, and any of these audit opinions come to your desk as a member of the board, it's always nice to know what they are and what they represent for the company on whose board you sit, or whose committee you sit, or whose company you represent in any of these capacities. Okay? And so this is why I kind of threw this stuff in there as well, just to give you a broad perspective as governance people, so you know that it's not all about part one of the course, which is board requirements and committee requirements and all that. It's also a financial side of it as well. And oftentimes financial compliance issues and governance issues are the ones that actually drown the company if they don't manage them well. All right. All right. So an unqualified opinion then is when the auditors are satisfied that everything is being done in accordance with generally accepted accounting principles. That means you've had a successful audit. When you have a successful audit, the auditors will give you an unqualified opinion. They won't qualify. They won't say that anything is wrong. A qualified opinion, on the other hand, is the opposite of an unqualified opinion. It suggests that the information provided by the company was limited. The auditors couldn't get all the information they needed to check stuff, because people keep saying stuff was lost, they can't find the file, somebody thieved it and burned up, or whatever it is we say in Bahamianese, to try to get the auditor not to see what they need to see. Whether it's legit or not, if the auditor cannot see everything they need to see, you might end up with a qualified opinion, okay? Which is not good. It's not terrible, but it's not good. Usually when you get a qualified opinion, the management is asked to find a way to make it possible for the auditors to get the information they need, check it out, and if it checks out, the auditors may then come back and say, okay, we've been able to verify, we can now give you an unqualified or clean audit. If you cannot do those things, you will remain in the unqualified opinion. Investors don't like unqualified. Creditors don't like unqualified. It expressed that something is wrong with that bloody company. Okay? Sorry, qualified. You always want an unqualified opinion from your auditors. So if you go to work,
Why they like that? Why the name mix up like that?
it sounds
Why unqualified is good and qualified is why the name like that?
big. Good question. We say it's unqualified because see, whenever something is wrong, we have to qualify by saying what's wrong. That's why we say if it's unqualified, nothing is wrong. If it's qualified, it means something is wrong because we have to say, we have to qualify by saying we can't find the file, we can't find the invoices, the cash flow doesn't represent all the transactions for the company, there are no reconciliations, whatever the problems are. So we say we qualify by saying what is wrong. All right, if nothing is wrong, then we say it's unqualified. I know it seems like a contradiction, but it's not. And so you have to learn it in exactly the context in which it is. Okay? It is not to be interpreted literally. It has to be interpreted for the purposes of accounting and auditing. And for accounting and auditing purposes, if it's unqualified, it means you have no problems with it. If it's qualified, it means you have problems with it. Okay? All right. An adverse opinion is even worse than an unqualified opinion. Sorry, a qualified opinion. If your auditor issues an adverse opinion, it is saying that the financial statements are misrepresented, misstated, and do not accurately reflect the performance of the company. In other words, some hanky-panky was going on, some fraudulent stuff is going on, too many errors are being made to mess up the financial statements and they were not corrected. So anytime auditors run into this kind of crap, they don't even issue a qualified report. They issue an adverse report, meaning that really we can't even fix that. All right. You just have to accept it as bad and come back next year and do it right. Usually when an adverse report is issued on a company, shareholders tend to fire boards. If it's a qualified opinion, they may not fire the board. They may tell the board, fix it within 3 months, and then if it's fixed, we'll let it go. If it's not, you have to go. But adverse, no fixing. You have to go, board. Because this is clearly poor governance. You've not been looking after our interests as shareholders and owners. This adverse report does not speak well. It's like getting a bad report card from school. It's like getting a bad performance appraisal report from your supervisor. It does not bode well. And you know what happens when you get a bad report from your supervisor? You either lose your job if it's bad enough, or if they keep you, you don't get that great big increase you were looking for. Instead of getting 5 to 7 to 10%, you get 1% or nothing, as we say in Bahamianese. Nothing this year. Go back and work hard and fix these things. That's what an adverse report is kind of like. All right, and the disclaimer, a disclaimer is the worst of all the reports. If your company gets a disclaimer, everybody has to go. Maybe the board, CEO, CFO, and all the other roles. This company is in trouble, right? And whenever an auditor issues a disclaimer of opinion, the auditor is saying three things. I am not an independent auditor, and therefore I cannot do this job the way it's required. If the auditor is not independent, if they work for the company or affiliated with the company, that will result in a disclaimer. Number two, when there's a conflict of interest, if the auditor comes in to do an audit and the partner of the auditing firm has business going on with the company they come to audit, that is a conflict of interest, and therefore a disclaimer has to be produced. Those things cannot exist with an auditor. They have to be completely independent of everything. Okay? If the auditor comes in and the partner is married to the CFO of the company they're coming to audit, that's not good. That's his wife? Man, for God's sake. That means if he finds something that she did wrong, what is he going to do potentially, class?
Cover it up.
Cover it up.
Yeah, he's going to cover it up. He's going to say, that's my wife. I can't say that she teeth him. What is sick? She'll put me in a doghouse and lose her job. So you can't have these conflict of interest issues. It doesn't work well. If it exists, there has to be a disclaimer. And then finally, a disclaimer of opinion will be issued when the limitation on the scope of the audit exists and the auditor is unable to obtain sufficient information and evidence to support any financial statements that they're auditing. In other words, if the auditor keeps asking for proof, invoices, receipts, bill of sale, real property tax, and whatever, you can't produce them. But man, this is hell. I cannot put my audit firm in jeopardy messing with this company. Where the hell did they have these information? Did they just lose them, or did they deliberately get rid of them? Either way, that's a serious limitation for the auditor. They cannot do the audit, and therefore they must issue a disclaimer Simple as that. All right. So these are governance issues because you can see why they're governance issues. They present real problems for the company. And any company that's getting a qualified opinion or disclaimer, or what's the third one? Anybody remember? Qualified disclaimer or what's the other one?
Sorry, I was mute. Adverse. I keep talking to myself.
If
Not
they-
adverse?
Adverse, yes, 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 okay? So you can see right away what kinds of short answer questions I can come up with. I'm just putting you on notice, just in case you were wondering. There are lots of little bits and pieces. They will not be difficult if you prepared, but if you didn't prepare and study and learn them and know them, then it'll be a nightmare, okay? Please know the difference between an internal and external audit. Internal audits are done by internal auditing management. External auditors are done by independent external auditors and auditing firms for their board of directors. Sorry, shareholders. Right? Please make sure you know the difference. It's asked. Differentiate between an internal and external audit. Don't be the student that says, you know what, I looked at that. I should have learned that. All right. So we'll stop there, and you will only be responsible for all that we've covered since your first exam up to tonight's information. It is not impossible once you commit yourself to learning it. Please make sure you know how to do those financial statements. You know these differences in audits, audit types, and all that kind of stuff. You know, be able to define.
Yeah, tell me what Mr. Costa wants you to do with this paper, please.
Sorry? What paper is that?
And put it in the Google Classroom.
She talking to a child.
She's talking to a child.
Oh, okay. So make sure you're familiar with.
I thought this exam, Mr. Wilkinson, only would have covered for everything from the second half going forward. So you saying we have to study everything from the first class up to this point as well?
No,
No, I did not say that.
Oh, okay, I probably misunderstood.
She
Indeed.
say from we do
Repeat it,
the
please.
midterm.
the two papers on financial literacy.
Yeah, everything after the midterm that we've done would be on your final exam. Nothing from the midterm
Okay,
will be in this examination.
Hi,
Okay,
good
yeah.
evening, Mr. Wilkinson. I came late. Thea here. The
Okay.
exam has actual accounting questions, calculations.
Yes, it will have calculations. Thea,
Okay.
you will be asked, no doubt, to do some basic journal entries. Remember those journal entries we did? You'll be asked to prepare financial statements, you know, those 4 statements that we talked about. So make sure you kind of dig into them and learn them as well as you can. And they really, like anything else, the only way to learn things as well as you can is to keep going over them until you're comfortable with them. There's no secret weapon. There's no magic. There are no magic tricks. You just have to go over them and over them until you're comfortable with them. If you have a casual affair with them, you will find that the examination will be more painful than normal, just like any other casual affair in life. But if you have a serious, intimate relationship with it, you'll find that your examination will be very fruitful. How's that? Just thought I'd put it that way so you could commit.
Mr. Wilkinson, just for confirmation again, when is the exam? Sorry.
Next week, Monday.
What?
The 22nd.
That's like that, right there.
You remember I told you some weeks ago, don't wait until we're getting upon the exam. You have to always start studying in advance. Because time flies. Can you believe that? Next week, Monday.
All
We'll
over.
be right here doing this exam. Just
Lord.
as we did the first one. Okay. So that means this weekend,
No drinking.
yeah, nothing.
Indeed, indeed, indeed.
Beginning tonight and all through this week, And this weekend that's coming up, don't do anything that you normally do. If you're married, tell your family you'll see them after the exam next Monday. How's that?
My Lord.
Yeah. Okay. Let me just make sure everybody's in class tonight. Paulette, are you
So
there?
you think we could get a sample?
Sorry?
Especially them trial balance questions.
No. All you need
I
to
was
do,
asking if we could get a sample, if we get sample like, and a practice exam to practice on this week. Could you email out a practice, something you could put together as a practice?
Yeah,
that-
mock exam.
yeah, if I send a mock exam, that makes it too boring.
Or just make this one open book. How about that?
Hell no, that's even more boring than
We
the
was
mock.
just checking. Let's just check it.
Absolutely. We want excitement on
This,
Monday.
my name is Ronaldo Toot, and I endorse that message.
So what about, okay, besides the definitions and stuff, we can have examples on the statements?
I gave you examples. I said you will be given information and asked to prepare statements. All you need to do now, should you choose to accept this impossible mission, is go and learn how to do those statements. They're not hard. You should remember the intimacy versus casual. If you're casual with it, you will not do as well as you could. Just like any casual relationship in life. But if
We're
you
not
are,
accountants.
I know. That's why you just sit down and practice them over and over. I'm not
Mr.
gonna ask you.
Wilkinson, this is gonna be rough. I have a new project.
Oh, I know. But if you commit, you'll be fine. Okay? I know it's gonna
You
be
sure you get an old exam from last year? You can do it again, Mr. Wilkinson.
that make it too boring. Then you just cruise
Dust
through
it off and send it out.
it takes away the excitement and the anticipation. All right? Just go ahead and study this crap. And when you finish studying, study it again. Practice the statements. Write out the stuff that you have, and then do it. See if you get it right. Write out the cash flow statement and do it. See if you get it right. Write out the trial. See like that, and just keep doing it over and over. The notes, like keep asking yourself, what are the different types of audits? What do they mean? And so when the exam time comes, it's like yes, log on it.
So how many questions is that again?
I don't know yet, but usually I give 10 to 12 definitions, roughly 10 to 12 short answer questions, and then your problems will be prepare financial statements. I'm already telling you in advance. So all you need to do is go and do it.
And it's basically centered around the 2 PowerPoint lectures that you did.
Absolutely. There will
Good.
be no surprises.
Okay.
Okay? I wouldn't go to my old accounting text and give you something that the accounting students that I've had. No, it's going to be centered around what we talked about in those. Okay? So don't worry about stuff coming out from left field. They'll be based on those same things we discussed. I
Coming
might
straight
change
out,
the
straight
numbers.
out of right field.
Yeah, I might change the context. I might change some of the wording, but I can't stray too far away, especially for the studiers. How's that? I don't know if that's a word. But if you're one of the studiers, like who did over and over and over and study, man, anything I ask you would be a piece of cake. Now, if you're one of those who partied and didn't commit, then it'll be a different kind of examination for you.
I have commitment issues.
If it's any consolation, you are not alone. That's why we have the sheep and the goats them in the classroom. Because some people do have commitment issues. Like, man, I'm trying to mess with that. I'm just gonna wing it the night before and see what happens. Okay. All right, Paulette, are you there?
I don't know, whatever.
Are you? Does that Paulette? Is that you? No. Okay. Is there anybody whose name I didn't call earlier?
Laura,
Yeah.
Yeah,
wait.
Yeah.
Kia, are you there?
Yes, sir.
Okay.
You calling Dara?
and Gia.
And Gia.
And Laura.
Thank you very much. Because when we started out, those names weren't there.
Indira? You got Indira?
Yes. What about Laura? Laura, are you there?
Yes, I have. Came in a bit late, but I'm here.
Great. Gia?
Here, I'm right here.
Good. That means everybody showed up eventually, which I'm happy about. Even though some of you came in a little bit late, you were here for the real hardcore good stuff, and that's good. Any other questions before we break and get ourselves ready for that bloody final exam next week?
How long is the exam gonna be?
Class time, 2.5 hours. Well, class time is 2
That's
hours.
which they should be expecting.
Class time is 2 hours, so your examination will be 2 hours.
Okay.
Mr. Wilkinson, just a concern. I know we had the exam posted. Because we have to do the postings and all of that, how will that work?
In terms of?
I mean, the up and down, like we did last time, will it be the same kind of format?
I hope not. I hope on Monday, Miguel would have his act together and would be using the actual software that will not cause us to have to do the up and down.
Okay.
Okay, so I'm keeping my fingers crossed. He said everything is good. He just missed something the last time. We got caught in the web. As I understand it, that matter has been resolved. So there will be no up and down according to my information. And I'm hoping that it's good intelligence. God forbid. All right, any other questions? If you
Yeah,
get
which
stuck,
they could be expecting practice exam.
Wednesday sounds about good.
that, that sounds like that's going to be a long dream. Hurry up and get up quickly and get to it, because that would be a pipe dream.
Oh, boy.
If you get stuck along the way and you have to ask a question to clear things up in your mind, please send me an email. I'll be happy to respond. All right, do not wait and come to class stuck on a particular concept that could cause you to get some extra marks that will take you from a 60 to a 70 or 70 to an 80, God forbid from 80 to a 90 something. All right, so if you get stuck on something, please raise it. It might be the difference between this and that. All right, so if you don't have any more pressing questions, please remember we start reviewing early. Make your weekend that's coming up a productive one, because remember you have lots of other weekends coming up. So the things you normally do this weekend, do not do them. Study, 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 so you can do well in your final. And then after that, you can knock yourself out. How's that?
Sounds like a plan.
Sounds good.
Fantastic.
Sounds good.
All right.
Yay.
I wish you guys a very busy week of studying along with the other problems in your life. And I'll see you on Monday, ready to get through this final and do well as most of you did in the first exam. Okay, do the same thing and you should be fine. There will be no surprises. Okay. So
Okay, thank you.
if there are no other questions, I shall please stay safe, get back in one piece, and I shall see you guys on Monday at 6 o'clock. Um, if some persons are running a little late, I mean that can happen, but try to get in at 6 o'clock so we can start at 6. If you do get in a little bit later, I'll make a decision about how to deal with that at that time. Okay. All right. So have a great week. Be safe, and I'll see you guys on Monday.
Thank you.
Okay.
Good
Bye-bye.
night.
Nice.
Good
Good night.
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 Night.